The silver price is lying and the spread is telling the truth. Because when a market stops being about opinions and starts being about delivery, the screen becomes the last place the real story shows up. Right now, you've got a familiar cast of characters trying to shrink this move into something safe and dismissible. Just a spike, just momentum, just retail noise. And that's exactly how a structural rally hides in plain sight. But there's a mechanism most people miss until it's already done the damage, and we're going to walk straight through it today. When the calendar squeezes decisions and nearby tightness shows up in the term structure, paper doesn't lead physical, paper chases it. And later in this video, I am going to give you a clean two-scenario roadmap for the next couple weeks. What confirms, what invalidates which levels matter, and what the market will try to do to your emotions while it's deciding. Because that's where the real pressure starts. Silver has a special talent for making smart people look foolish. Not because they're wrong on fundamentals, but because they underestimate how violently silver enforces timing. It's not a polite market. It doesn't negotiate with your patience. It tests your conviction with whipsaws, headlines, and sudden air pockets where liquidity thins, and everybody pretends they never cared. And that's the first reason this rally feels different. The tape is fast, yes, but the surrounding plumbing is moving too. You're not just seeing a price print climb. You're seeing behavior change across the ecosystem, hedgers adjusting, dealers recalibrating, and the physical side quietly refusing to act like there's endless slack. But that's not the part that matters. The part that matters is why those behaviors show up now, not 6 months from now, not sometime this year, but right around this stretch of the calendar where metals have a habit of revealing who swimming naked. Here's the clean way to frame it. Price is a vote, structure is a verdict. Price can be emotional, structure is math. When silver rips, stalls, snaps back, then rips again, the easy story is speculators. The harder story is the one you can actually trade and risk manage. Who is forced to do what, by when, and at what cost? Because if this one level breaks, the math changes. Start with the basic map. Silver trades in multiple layers at once. You've got spot, the here and now urgency. You've got futures, promises to deliver later, standardized and tradable, a giant risk transfer machine. You've got options sitting on top, convexity, gamma, dealers hedging flows. You've got ETFs and ETPs, pipes that pull metal into vaults when investors buy exposure and sometimes push it out when they sell. And you've got the industrial world, fabricators, electronics, solar supply chains, who don't care about your chart pattern. They care about whether the metal shows up when the production line needs it. When those layers align, silver trends. When they conflict, silver turns into a psychological warfare simulator. And the hidden detail in this rally is that the conflict is shifting. People stare at the headline price like it's the truth. But in commodities, the truth is often hiding in the spreads. The difference between the near month and the next month, the cost of immediacy, the premium for now. If the front end tightens, it's the market's way of saying, if you want it, you pay up, and you pay up today. That's a very different animal from a rally that's purely risk-on sentiment, and that's exactly why the calendar matters. Silver doesn't squeeze on vibes, it squeezes on deadlines. Futures contracts aren't just numbers, they come with rules. Last trade dates, first notice days, delivery windows, roll periods. As those dates approach, participants have to make a choice. If you're long a futures contract, you either roll it, close it, or stand for delivery. If you're short, you either buy it back, roll it, or deliver. That's not philosophy, that's obligation. And when the market is calm, rolling is easy and cheap. When the market is tight, rolling gets expensive and delivering gets complicated. That's where the real pressure starts. Now let's talk about what you've seen on the surface, because it matters for psychology. Silver has been printing levels that feel, frankly, unreal to anyone anchored to the old range. It ripped up into the kind of price zone that turns every conversation into a morality play. Either you relate and furious, or you're early and terrified, or you're skeptical and suddenly quiet. And then it snapped back hard enough to make people swear off the trade entirely. That kind of price action is not an accident. It is the market doing what it always does when it transitions from one regime to another. It punishes certainty. Bulls get punished for leverage and impatience. Bears get punished for arrogance, and it can't. Meanwhile, the real money, especially money that moves through structure, not emotion, watches the plumbing. Because the next detail is what flips the whole setup. If you want to understand why this rally feels different, you need to stop asking, is silver expensive? And start asking, is silver available, on time, at scale, in the place that matters for price discovery? Those are not the same question. And this is where that hidden detail comes in. Inventory. Headlines are often meaningless without the category and the deliverability. In the silver world, a lot of metal exists that is technically inventory, but not all of it is deliverable into the mechanism that sets the marginal price. Some is held in forms, locations, or ownership structures that make it sticky. It's there, but it's not for sale. And even metal that could be sold might not move quickly due to logistics, fabrication schedules, assay, and the basic reality that metal doesn't teleport. So when a delivery window approaches and the market needs immediate metal, the only supply that matters is supply that can actually show up in the right spec at the right time. That's why you can see the price move too far, too fast, and still have a rational mechanical explanation underneath. But that's not the part that matters. The part that matters is how the market signals that tension. It signals it in the term structure. In plain English, if the market is relaxed, the forward months often trade a bit above spot because storage and financing cost money. That's contango. If the market is tight, the near price can trade above the forward price because immediacy is valuable. That's backwardation. And you don't need a PhD to translate what it forces participants to do. If the near month is expensive relative to the next month, shorts feel pain. Rolling a short position forward costs more. Delivering becomes the path of least resistance, if you can deliver. If you can't deliver, you have to buy back the short. That's forced buying. And forced buying is rocket fuel in a market where liquidity is already thinning. But wait, there's another layer, options. When silver makes a sharp move through popular strike zones, big round numbers, widely watched levels, dealers who sold options have to hedge. If the move is fast enough, hedging can become reflexive. Price rises, hedges require buying. Buying lifts price, which requires more hedging. That's how a market can feel like it's sprinting downhill on ice. And that's why you see those sudden vertical candles and then brutal pullbacks. Because once the hedging wave passes or once profit-taking hits, the same thin liquidity amplifies the move back down. That's why this market will try to emotionally manipulate you. It will make you feel genius and then stupid in the span of 48 hours. And if your plan is to feel confident, silver will break you. Because this market is designed to weaponize doubt. Here's the proof stack, because we're not doing vibes today. Proof point 1, the underlying supply-demand balance has been tighter than most people want to admit. Industry surveys and annual reviews have described a multi-year stretch where demand has exceeded supply, creating a structural deficit that has to be filled by drawing down above-ground stocks. Think of it like a reservoir. You can run a deficit for a while and nobody panics because the taps still work. But every year you drain that reservoir, you reduce the system's ability to absorb shocks. Then one day, a perfectly normal-looking demand surge or a normal-looking delivery window hits, and suddenly the water pressure drops. That's when the market stops trading like a spreadsheet and starts trading like a scramble. Recent industry estimates pegged last year's deficit in the neighborhood of roughly 150 million ounces, give or take, and described it as part of a streak of consecutive deficit years. You don't need to memorize the exact figure. You just need to understand what it implies. Less buffer, more sensitivity, more potential for timing-driven squeezes. And that's where the real pressure starts. Proof point 2, industrial demand isn't a side character anymore, it's a base load engine. There are only so many commodities that get to be both a monetary metal and an industrial input. Silver is one of them, and that dual identity is why it's such a drama machine. In the last year, industrial demand was described by major survey work as setting records, hundreds of millions of ounces, with photovoltaics as a major contributor. And here's the key. Industrial demand doesn't care about your macro mood. A manufacturer doesn't shut down a production line because a pundit said recession risks. They might slow, they might adjust procurement, but they can wish away the need for a critical input that has a specific set of properties. Yes, there's thrifting, using less silver per unit. Yes, there's substitution in some applications, but those take time. They require re-engineering, qualification, reliability testing, and often a trade-off in performance. So even when thrifting exists, demand can remain stubbornly large in aggregate, especially when the scale of deployment is enormous. Which brings us to proof point 3. The scale of solar build-out in key regions has been staggering, and it matters for silver not as a story, but as a procurement reality. In recent commentary and survey material, China's annual added solar capacity was described at a scale that would have sounded absurd a decade ago. Hundreds of gigawatts added in a single year. Whether the exact number is 270, 280, or somewhere nearby, the point is the same. That's not a trickle, that's an industrial river. And rivers carve valleys. Big procurement programs create forward demand, they change inventory practices, and they can trigger just-in-case buying when supply chains feel uncertain. That doesn't mean every week is a panic. It means the baseline pull stays high and the system has less slack. And that is the kind of quiet pressure that makes a delivery window more consequential than it should be. Proof point 4, the investment pipes have been changing tone. For a long time, silver investment flows through exchange-traded products have been choppy. Sometimes outflows, sometimes inflows, often a headwind. But recent survey tables and market commentary have pointed to a shift where net ETP investment turned positive again, with inflows measured in tens of millions of ounces across a year, and forecasts for continued inflows depending on macro conditions. Here is why this matters in plain English. An ETF inflow is not just a chart event, it's a physical event. It requires sourcing metal and storing it. When inflows happen during a period of already tight deliverability, it can amplify tension because you're competing for the same marginal ounces. And once that pipe turns on, it can become reflexive. People buy because price is rising. The fund buys metal because people buy. Metal gets tighter because the fund buys. Spreads tighten because metal gets tighter. And then the market looks strong structurally, pulling in more buyers. That loop doesn't last forever, but when it's active, it can feel like the market is being pulled forward by an invisible current. But that's not the part that matters. The part that matters is that these flows don't need to be gigantic to matter. Silver is a smaller, more volatile market than people intuit. It doesn't take a planet-sized whale to move it. It takes a shift at the margin. Proof point 5, physical premiums and sourcing stress have been showing up in places that actually consume and trade size. Recent reporting out of India, for example, described a shortage dynamic where physical silver was trading at meaningful premiums to the benchmark, in some cases around 10%, and even led to unusual measures, like some funds pausing fresh subscriptions because the cost of acquiring physical exposure had become too steep relative to the published reference price. That's not a conspiracy, that's a market symptom. It is the simplest kind of truth. If it costs materially more to get real metal than the paper price implies, the paper price eventually has to respond, or the market has to ration demand. And rationing demand in silver often happens through volatility, sharp moves that force weak hands out. Proof point 6, inventory data from major vaulting hubs can be misleading unless you account for location and accessibility. London vault holdings might tick up in a given month, while deliverability elsewhere is tight, and those two statements can both be true at the same time. Metal in the wrong place can still mean tightness where price is set, because moving metal involves time, money, and frictions, assay, transport, insurance, and in some cases, the reluctance of holders to part with it. That's the hidden tax of geography. So when people say there's plenty of silver, the correct response isn't to argue emotionally. The correct response is plenty where, in what form, at what price, and how fast. Because if the answer is it exists, but it's sticky, that's how squeezes happen without anyone needing to be a cartoon villain. It's just incentives and constraints. Now let's Steelman the skeptic case, because if you can't articulate the bear thesis, you're not doing risk management. You're doing religion. The bear argument goes like this. Silver has ripped too far too fast. Parabolic moves mean mean reversion. Profit taking will be violent. Macro shocks like a sudden jump in real yields or a dollar rally can crush precious metals. Industrial demand could cool if growth slows. Substitution and recycling can increase supply. Critically, paper volume can overwhelm physical signals in the short term, causing the physical tightness narrative to get steamrolled. That's a real set of risks, and if you ignore it, silver will punish you for it. But here's the rebuttal in mechanisms, not slogans. First, yes, parabolic moves revert, but in a structural transition, reversion often looks like a pullback and retest, not a collapse back to the old world. That's how markets reprice when they discover a new equilibrium. Second, macro shocks do hit metals, but silver is not only a macro metal, it's also an industrial metal. Sometimes that dual identity dampens the impact of a purely monetary narrative. Third, substitution and thrifting are real, but they operate on engineering time, not trader time. They don't save you in the next 2 weeks. Fourth, paper can overwhelm physical until it can't. The moment paper tries to push price too far below the cost and reality of acquiring metal, the physical market responds by pulling supply off the table, raising premiums, delaying delivery, or shifting procurement behavior. That's how physical defends itself, quietly, not theatrically. And that's where the real pressure starts. So what makes this rally feel different right now? It's the alignment. You have a backdrop of multi-year deficit pressure. You have industrial demand at record-like levels, with a major component tied to ongoing build-outs that don't stop on a dime. You have investment flows showing signs of turning from headwind to tailwind. You have on-the-ground premium signals in at least some regions. And then you have the calendar, delivery windows, month-end, and the thin liquidity conditions that make forced behavior more likely to show up as dramatic price movement. And on top of that, you have psychology. Silver is not just an asset, it's a test. The market will try to manipulate you with narrative whiplash. One day it's silver is the future. 2 days later it's silver is collapsing. Then it's silver is manipulated. Then it's silver is irrelevant. Most of that noise exists to make you react instead of think. Here's your psychology shield. First, separate trend signal from noise. Trend signal is structure. Higher highs and higher lows over a meaningful window, breakouts that hold, pullbacks that find support, spreads that stay firm, and flows that persist. Noise is intraday drama, headline spikes, and volatility designed to force you into impulse decisions. Second, assume volatility even if you're right. Silver can whip around violently even if the thesis is correct. In fact, that's often how the thesis expresses itself, through sharp squeezes and sharp flushes. Third, size your decisions so you can survive being early. Because if your position forces you to be right today, you're basically volunteering to get harvested by the market's mood swings. And fourth, decide in advance what invalidates your thesis, not what makes you uncomfortable, what actually breaks the setup. Because if you don't define invalidation, the market will define it for you at the worst possible moment. But that's not the part that matters. The part that matters is what comes next, and we're going to make it concrete with a two-scenario lens that keeps you honest. Scenario 1 is the controlled pullback and retest. This is the market doing the professional thing. It takes a breath, it shakes out late leverage, it revisits the breakout zone, and then it decides whether buyers defend. In this scenario, you'll often see price dip into the prior breakout area. Think the high 80s to low 90s zone if that Hess where the latest acceleration happened. Then stabilize. You may see violent wicks, because silver loves theatrics, but the closes matter. You'll also want to watch whether the front-end structure stays firm. If spreads remain tight and nearby doesn't collapse relative to deferred months, that's a sign the physical clock is still ticking. You may also see the news cycle turn negative right at the low, because markets love to print the scariest headline at the point of maximum discomfort. If this scenario plays out, it sets up the more sustainable continuation. It's the market building a platform. The invalidation for this scenario is simple. If price fails to reclaim the breakout zone after a retest and structure relaxes, spreads soften, urgency fades, flows reverse, that suggests the move was more speculative than structural, at least in the near term. Scenario 2 is the continuation squeeze, and this is where people get hurt, both bears and impatient bulls. In this scenario, silver doesn't give the market a clean retest. It consolidates briefly, then pushes again, often during thin liquidity, overnight sessions, post-weekend gaps, or around key roll and notice periods when hedgers have to act. The trigger is usually not good news. It is usually a mechanical pinch, a burst of buying that forces shorts and dealers to chase, combined with a market that can't offer enough liquidity without moving price sharply. In this scenario, round numbers become magnets. If you're trading psychology, $100 is not just a number. It's a strike cluster, a headline generator and a line in the sand for positioning. When the market approaches it, behavior changes. Dealers hedge, shorts sweat, funds smell blood, and suddenly the tape feels like it's being pulled forward by a winch. But here's the danger. Squeeze scenarios come with gap risk. They can also reverse violently once the forced buying is satisfied. That's how silver turns euphoria into regret in a single session. So if scenario 2 is your base case, your risk management has to assume the move can rip higher and still punish you with a drawdown that feels illegal. That's not exaggeration, that's silver. Now, how do you actually watch this in real time without getting hypnotized by the candle chart? You watch a checklist. First, levels. Pick the recent acceleration zone and treat it as the battlefield. If silver rallied through the high 80s and low 90s quickly, that region matters. Above it, the market is saying the new range is real. Below it, the market is testing whether the move was overextended. Next, watch the big psychological level, $100 if it's in play, and don't treat it like a target promised by destiny. Treat it like a stress test. If price approaches it and the market hesitates, that's normal. If price approaches it and blasts through on momentum with firm structure, that's a different message. Second, watch for confirmation through structure. You don't need perfect data access to think structurally. You can ask simple questions. Does the market still pay a premium for immediacy, or is that fading? Are there signs of physical stress, premiums, availability issues, sourcing costs that persist even after pullbacks? Do investment flows seem sticky or fickle? Third, watch the calendar. As we move through key notice and delivery-related dates and month-end positioning, the market becomes more sensitive to forced behavior. That's when squeezes and flushes are more likely, not because the market is haunted, but because participants face constraints. Fourth, watch your own brain. If you feel an urgent need to do something right now, that's usually the market doing its job on you. Step back and ask, did the structure change, or did my emotion change? Because that one question saves accounts. And here, it's the subtle truth that separates people who survive silver from people who get churned. You don't need to predict every tick. You need to stay aligned with the regime and manage risk so you can be wrong short-term without being destroyed long-term. In a structural rally, the best opportunities often show up when the market tries to convince you it's over. The dump, the scare headline, the "see told you." That's where the market attempts to reset positioning. Sometimes it works and the rally dies. Sometimes it fails and the rally resumes stronger. The difference is in the proof points we've talked about: term structure firmness, physical signals, flow persistence, and how price behaves around the breakout zone. But that's not the part that matters. The part that matters is what you do with this information. This is not a promise of guaranteed returns. This is not a prophecy. It's a framework. And frameworks are how you keep your head when the tape gets violent. If you want a clean interpretation of what silver is doing right now, think of it like this. The market is negotiating a new range, and the negotiation is happening under time pressure. Time pressure makes people do irrational-looking things for rational reasons. A short doesn't cover because they change their worldview. They cover because margin and deadlines demand it. A dealer doesn't buy because they believe. They buy because hedging requires it. A fabricator doesn't pay a premium because they love pain. They pay it because production deadlines exist. That's the choreography. That's why this rally feels different. It's not just price enthusiasm. It's obligation meeting constraint. And obligation plus constraint is how you get moves that don't care whether you feel ready. Now let's land this with a final practical roadmap for the next week or two. If you see controlled pullbacks that hold above the prior breakout zone with repeated defenses and the market refusing to fully unwind its urgency signals, that leans towards scenario 1, resolving bullish platform, then continuation. In that world, your job is to avoid panic during the pullback and avoid FOMO during the next push. You let structure confirm, you let the market prove it. If instead you see the market fail to reclaim key zones after a pullback, with spreads and physical signals relaxing and flows turning fickle, that leans toward the near-term top being in. In that world, the correct response isn't despair or denial, it's patience. Silver can reset for longer than people expect. And if the longer-term thesis is real, it will reemerge with new structure. The worst move is turning a near-term mistake into a long-term injury because your ego needs to be right. And if you see scenario 2, the squeeze, where the market compresses and then launches higher during thin liquidity, breaking psychological levels and forcing chasing, your job is to treat it with respect. Respect means acknowledging gap risk, respecting that pullbacks can be savage even in the middle of a squeeze, and remembering that silver's favorite hobby is to punish late entries right before it continues. So you don't worship the candle. You manage the risk. One last thing, because it matters for trust. There will be people who try to turn this into a simple morality play. Heroes versus villains, good metal versus bad paper. Reality is more boring and more useful. Markets are incentive machines. They do what they do because participants optimize under constraints. Sometimes that looks like suppression. Sometimes it looks like panic. Most of the time, it's just risk management colliding with physics and deadlines. If you can stay focused on mechanisms, spreads, deliverability, flows, and the calendar, you don't need to argue with narratives. You just need to watch what the market is forcing people to do. And if you were the kind of person who wants finance coverage that doesn't insult your intelligence, who can handle urgency without getting hypnotized, and who prefers proof stacks over slogans, then you already know the community vibe we're building here. Calm minds in violent markets. Keep your checklist tight, keep your position size honest, and remember, silver can whip you even when you're right, and that is not a reason to quit. It is a reason to trade it like a professional.